If I had to start a Roth IRA from zero in 2026, I would not begin by searching for the hottest stock, the perfect ETF, or the portfolio that performed best last year. I would begin by building a system simple enough to follow for decades. That system would have 6 steps. Confirm that I am eligible to contribute, open the right type of account, deposit an amount I can realistically sustain, invest the deposited cash, automate future contributions, then stay invested while ignoring most of the financial noise competing for my attention. That last step may sound too simple, but it is where much of the long-term value is created. A Roth IRA can potentially allow investments to grow without annual taxes on dividends, interest, or realized gains inside the account. Qualified withdrawals in retirement may also be tax-free. But those benefits do not eliminate investment risk, and they do not compensate for poor behavior. A complicated portfolio that is constantly changed can produce worse results than a simple, diversified portfolio that is consistently funded. Starting from zero is not a disadvantage. It is an opportunity to avoid years of unnecessary funds, excessive fees, and random decisions. My objective during the first year would not be to become an expert on every investment. It would be to create a repeatable process that converts part of every paycheck into long-term retirement assets. Before choosing those assets, however, we need to understand what a Roth IRA actually is, because the account and the investment inside it are two completely different things. A Roth IRA is not an investment. It is a type of retirement account with a specific set of tax rules. Think of it as a financial container. The container may hold index funds, exchange-traded funds, individual stocks, bonds, or even cash. Opening the container does not automatically create investment growth. The return depends on what is purchased inside it. This distinction explains one of the most common beginner mistakes. Someone opens a Roth IRA, transfers money into the account, and believes the process is complete. But the contribution may remain in a cash settlement position, earning little while never receiving meaningful stock or bond market exposure. The Roth IRA provides the tax structure. The portfolio provides the investment risk and potential return. Contributions are generally made with money that has already been taxed. There is no immediate federal deduction for an ordinary Roth IRA contribution. In exchange, qualified withdrawals may eventually be received tax-free. That can be valuable for someone who expects decades of investment growth or who wants more control over taxable income during retirement. But the tax advantage only becomes useful when the account is funded correctly and the money is actually invested. So before choosing a fund, I would confirm 3 things. Do I have eligible compensation? How much am I permitted to contribute? And is my income within the limits for a direct Roth IRA contribution? Those questions lead directly into the 2026 rules. For 2026, the total annual contribution limit across traditional and Roth IRAs is $7,500 for someone under age 50. For someone age 50 or older, the total rises to $8,600 because of the catch-up contribution. The word total matters. You do not receive one limit for a traditional IRA and another full limit for a Roth IRA. If you contribute $3,000 to a traditional IRA, that generally leaves $4,500 of the under 50 limit available for a Roth IRA. The next requirement is taxable compensation. A person generally cannot contribute more than the annual IRA limit or eligible compensation for that year. If someone earns $4,000, a $7,500 contribution is not permitted merely because the annual limit is higher. Direct Roth IRA eligibility also depends on modified adjusted gross income and filing status. For 2026, the contribution phase-out for single filers and heads of household runs from $153,000 to $168,000. For married couples filing jointly, it runs from $242,000 to $252,000. Married filing separately can be significantly more restrictive when the spouses live together during the year. I would verify these rules before setting an automatic maximum contribution. Excess contributions can create additional taxes until corrected. But eligibility does not automatically mean the Roth IRA should receive the next available dollar. Before funding it aggressively, I would check whether another financial priority offers a stronger or more immediate benefit. A Roth IRA is an excellent retirement account, but it should not exist in isolation from the rest of the financial plan. My first question would be whether an employer offers a retirement plan match. A match is part of compensation. Ignoring it to fund a Roth IRA may mean giving up money the employer was prepared to contribute. In many situations, I would contribute enough to the workplace plan to capture the full match before prioritizing additional Roth IRA contributions. Next, I would protect basic liquidity. Investments can decline at the exact moment an emergency occurs. Without cash reserves, a medical bill, job loss, or major repair may force the investor to sell during a weak market or return to high-interest debt. The emergency fund does not need to be perfect before the first Roth contribution is made, but the cash flow should be stable enough that retirement investments are not repeatedly withdrawn. I would also evaluate high-interest debt. Paying down a credit card balance charging an extremely high rate creates a guaranteed reduction in interest cost. Stock market returns are uncertain and should not be compared as if they were guaranteed. This does not require one rigid order for every household. Someone with stable income and moderate debt may build emergency savings, reduce debt, and fund a Roth IRA at the same time. The principle is more important than the exact sequence. Do not use rent money to invest. Do not abandon an employer match. And do not expect a tax-advantaged account to repair fragile cash flow. Once the foundation is stable, the next decision is where to open the Roth IRA. I would choose a Roth IRA provider based on whether it makes good investing behavior easy. The first factor would be cost. I would avoid unnecessary account maintenance fees, expensive trading features, and investment products with high ongoing expenses. The second factor would be access to diversified, low-cost index funds. A beginner does not need thousands of exotic securities. A few broad funds or even one well-designed fund can be enough to build a complete retirement portfolio. Automation would be another priority. The platform should allow recurring bank transfers and ideally automatic investment of those contributions. Those are not always the same feature. Some accounts automatically transfer cash but leave it uninvested until the owner manually places an order. Fractional investing can also help. It allows a small contribution to be invested without waiting until enough cash has accumulated to purchase a full share. Security matters as well. I would use strong authentication, unique passwords, and a recognized custodian. SIPC membership may provide protection when customer assets are missing after a member brokerage fails, but it does not protect against ordinary investment losses. If the market falls, SIPC does not restore the portfolio to its previous value. I would not select a provider only because it offers a temporary bonus, a colorful interface, or more trading tools. The best provider is the one that supports low costs, broad diversification, and consistent automation. After opening the account, the more important decision begins. What should actually be purchased inside it? Starting from zero, I would prefer one strong core investment over a collection of disconnected ideas. The simplest option would be a low-cost target date index fund. A target date fund typically combines United States stocks, international stocks, and bonds inside one portfolio. It automatically rebalances and usually becomes more conservative as the target retirement year approaches. For someone who wants a professionally designed portfolio with minimal maintenance, this can be a complete solution. The important detail is the word index. Some target date funds are inexpensive and broadly diversified. Others may have higher fees or use more active management. The alternative would be a broad United States total market index fund. This can provide exposure to large, medium-sized, and smaller public companies through one holding. It is simple, diversified, and easy to understand. But a United States fund alone is not a complete global portfolio. The investor would eventually need to decide whether to add international stocks and bonds. I would choose between these paths by asking one question. Do I want automatic portfolio management, or do I want more control? The target date fund offers greater simplicity. The broad market fund offers more flexibility, but creates more future decisions. What I would not do is buy 10 ETFs merely because 10 feels more diversified than one. Several ETFs may own the same companies repeatedly. One broad fund can sometimes be more diversified than a complicated portfolio filled with overlapping products. If I chose to build the allocation myself, I would keep the structure equally simple. For an investor with a long time horizon and the ability to tolerate major market declines, an illustrative starting portfolio could hold 70% in a broad United States stock market fund, 20% in international stocks, and 10% in high-quality bonds. This is an example, not a universal allocation. The United States allocation provides exposure to thousands of domestic companies. The international allocation reduces dependence on one country and includes businesses operating across developed and emerging markets. The bond allocation can reduce some portfolio volatility and provide a source for rebalancing when stocks fall. A younger investor with stable income and high risk tolerance might choose fewer bonds. Someone closer to retirement with uncertain income or a lower tolerance for losses might use more. The technically optimal portfolio is not useful if the investor abandons it during the first bear market. That is why risk tolerance should not be measured by how someone feels when markets are rising. It should be measured by the decline they can realistically hold through without panic selling. A portfolio containing mostly stocks may temporarily lose a substantial part of its value. That is not a prediction. It is a normal risk of owning volatile assets. The one-fund target date approach remains a valid alternative for someone who does not want to make these allocation decisions. Whichever structure I selected, I would document the reason for owning it and avoid changing it because of headlines. The portfolio creates the strategy. Consistent contributions create the habit. So the next step would be deciding how to fund the account throughout 2026. For someone under age 50 who is eligible for the 2026 contribution, $7,500 equals $625 per month. But I would not delay opening the account because $625 feels unaffordable. The better starting amount is the amount that can be contributed consistently without creating new debt or draining emergency savings. That might be $50, $100, or a fixed percentage of every paycheck. I would automate the contribution shortly after payday. This treats retirement investing like a recurring obligation instead of a decision that must be reconsidered every month. Then I would confirm that the contribution is automatically invested. A recurring bank transfer that lands in cash is not the same as a recurring investment. If I already had the full contribution amount available and the rest of the financial plan was protected, I could invest it as a lump sum. Investing earlier gives the money more time in the market. But lump sum investing is not automatically correct when the cash is needed for near-term expenses, high-interest debt, or the emergency fund. Monthly investing can also be useful for behavior. It reduces the emotional pressure of selecting one perfect entry point. As income increased, I would raise the automatic contribution before lifestyle spending absorbed the difference. The objective would be to reach the annual limit when financially reasonable, not to force the maximum at the expense of stability. By this point, the plan is deliberately boring, and that is exactly where the channel's larger investing philosophy fits. If you prefer retirement investing without stock-picking hype, overnight wealth promises, or portfolios designed mainly to look impressive, subscribe to Boring Money Wins. The Roth IRA plan we are building does not depend on predicting the next winning company. It depends on a much more controllable process. Open the account, fund it consistently, buy a diversified investment, automate the next contribution, review the plan occasionally rather than reacting to every market movement. If this approach is helping you turn retirement investing into a practical system, click the like button. That helps YouTube recommend the video to more people who want to start investing but feel overwhelmed by unnecessary complexity. Simple does not mean risk-free. A diversified portfolio can fall. Tax rules can change. Personal income and financial priorities can change as well, but a simple process makes it easier to identify what needs adjustment without rebuilding the entire portfolio every year. The best plan is not the one that looks most sophisticated in a screenshot. It is the one that continues operating through busy months, frightening headlines, and ordinary market declines. And even a perfectly designed plan can fail if one small operational step is missed. The contribution enters the Roth IRA, but the cash is never invested. That is the beginner mistake we need to examine next.
Imagine two investors who each contribute $7,500 to a Roth IRA. The first investor purchases a diversified long-term investment. The second leaves the entire contribution in the account's cash position. Both investors can truthfully say they funded a Roth IRA, but economically, they are following very different strategies. The first investor has accepted market risk in pursuit of long-term growth. The second may be earning only the return available on the account's cash sweep or settlement fund. Cash can be appropriate for money needed soon, but retirement money with a multi-decade horizon may lose significant purchasing power if it remains permanently uninvested. The account statement can make this mistake difficult to notice. The total balance may still show $7,500. The contribution was completed. There was no failed transaction. The missing step is visible only when the owner checks the holdings. I would verify that the account contains the investment I intended to purchase. I would also confirm that future contributions are directed into that investment, rather than accumulating in cash. This should be checked after opening the account, after changing banks, after transferring providers, and whenever an automatic investment instruction is modified. There is no need to monitor it every day. A quick verification can prevent years of accidental inactivity. Once the cash is invested, the next danger is moving too far in the opposite direction, turning a long-term retirement account into a place for constant speculation. A Roth IRA offers valuable tax-advantaged space. I would not use that space as a casino. The first thing I would avoid is concentrating the account in meme stocks or one exciting company. The potential upside may be large, but the retirement outcome becomes dependent on one business and one story being correct. I would also avoid chasing the highest dividend or distribution yield. A large yield can result from falling prices, excessive leverage, risky credit, or a distribution that may not be sustainable. Income is not free return. The market value and total return still matter. Overlapping ETFs are another source of unnecessary complexity. Three funds with different names may all be dominated by the same group of large companies. Owning more tickers does not guarantee broader diversification. Constant trading creates more opportunities for emotional mistakes. A Roth IRA may shelter trades from current capital gains taxes, but tax-free trading is not the same as intelligent trading. Poor timing and poor security selection can still destroy value. Finally, I would avoid high ongoing fees. A small annual expense can compound into a meaningful reduction over several decades. The Roth IRA's tax advantage makes long-term compounding valuable, which makes unnecessary fees especially frustrating. My default position would be a low-cost, diversified core, changed only when the financial plan changes, not when social media becomes excited. The account should remain focused on retirement. However, Roth IRAs do offer more withdrawal flexibility than many people realize. Understanding that flexibility requires separating contributions from earnings. Regular Roth IRA contributions are made with after-tax money. Under the Roth IRA ordering rules, regular contributions are generally treated as distributed before conversions and investment earnings. That means an amount equal to previously contributed principal may be generally withdrawn without federal income tax or the 10% early distribution penalty. Suppose someone contributed $8,000 over several years and the investments grew to $12,000. The account contains $8,000 of contribution basis and $4,000 of earnings. A withdrawal that remains within the contribution layer is treated differently from a withdrawal reaching the earnings. Earnings are more restricted. For a qualified distribution, the Roth IRA generally must satisfy the applicable 5-year requirement, and the distribution must occur after age 59.5 or meet another qualifying condition. Conversions introduce additional rules, but they are separate from the basic beginner contribution example. This flexibility can make the Roth IRA feel like a backup emergency account.
Technically accessible does not mean strategically disposable. Withdrawing contributions removes money from tax-advantaged space that may be difficult or impossible to replace later. The lost future compounding can be much larger than the amount withdrawn. I would therefore maintain a separate emergency fund and treat Roth withdrawals as a last resort option rather than a normal source of cash. As income and savings capacity grow, the Roth IRA strategy becomes more complicated. Direct contribution eligibility may decline, a spouse may add another account, and taxable investing may become necessary. Higher income creates more saving capacity, but it can also reduce eligibility for direct Roth IRA contributions. The first expansion may be a spousal Roth IRA. When a married couple files jointly, one spouse's eligible compensation may support contributions for both spouses, subject to the rules and combined compensation available. The accounts remain individually owned. A Roth IRA is never a joint account. If household income exceeds the direct contribution limit, a backdoor Roth strategy may become relevant. The basic process involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA. There is no income limit preventing a Roth conversion, but this does not make every backdoor Roth tax-free. The pro rata rule may cause part of the conversion to be taxable when the investor holds pre-tax money in traditional, SEP, or simple IRAs. Accurate Form 8606 reporting becomes essential. This is an area where a tax professional may be valuable. After tax-advantaged opportunities have been considered, additional long-term savings can be directed to a taxable brokerage account. The taxable account has no IRA contribution limit and may provide greater access before retirement. But dividends, interest, and realized gains can create current taxes. The financial plan may therefore combine a workplace retirement account, Roth IRA, health savings account when eligible, and taxable investing. More income creates more options, but it also creates more tax details. The basic behavior remains unchanged. Save regularly, invest broadly, and automate the process. That brings us to the exact first-year plan I would use to turn a $0 Roth IRA into a functioning retirement system. If I started from zero in 2026, my first step would be verification. I would confirm taxable compensation, filing status, income eligibility, and the contribution limit that applies to me. Second, I would open a low-cost Roth IRA with strong security, broad investment choices, and reliable automation. Third, I would make the first contribution immediately, even if it was much smaller than the annual maximum. Starting the process matters more than waiting until the perfect amount becomes available. Fourth, I would invest the contribution. For the simplest approach, I would consider one low-cost target date index fund. For more control, I could use a small group of broad market index funds covering United States stocks, international stocks, and bonds. Fifth, I would automate contributions every month or every payday. I would also automate the investment purchase when the platform permits it. Sixth, I would review the account once or twice during the year. I would confirm that contributions are invested, check progress toward the annual limit, and rebalance only when the allocation moves meaningfully away from the plan. I would not rebuild the portfolio because one sector performed better for 6 months. I would not stop contributing because the market declined, and I would not wait until I felt like an expert. At the end of the year, I would verify the total contribution to avoid exceeding the limit. Then I would increase the automated amount whenever income allowed. The complete plan is not dramatic. Open the account, fund it, invest the cash, automate the habit, increase contributions over time, then allow decades, not daily decisions, to do most of the work. Boring account, broad diversification, consistent contributions. That is exactly how boring money wins.